I'm Nicholas Borners of Capital Link, and I would like to welcome you all to Capital Link's webinar series. Today's discussion will focus on the LPG sector. We are gratified to have with us three major industry participants, and I'd like to thank Jorgen Lian, the head of shipping equity research at DNB Markets, who's going to be the moderator. I will turn it over to Lian to introduce our panelists. I would like to mention that our participants can submit questions through the feature on the webinar page, and your questions can be addressed by the panelists as we go or at the end of the discussion. So I'd like to thank you very much all for joining. I think what is happening in the LPG sector is quite exciting and interesting. And Jorgen, the floor is yours to introduce the panelists. Thank you.
Thank you so much, Niklas, and thanks for having me and us here. And I'm very pleased to have a strong panel, I feel, to discuss the very interesting LPG shipping sector, and maybe we'll get out of this with a lot more knowledge as to where we are and what's going on and how things are shaping up going forward, which I assume all the listeners are looking forward to. So with that, if I start to my right, we're joined today with the CEO in Navigator Holdings, which Mats Petter Zacho. So welcome. And then we have Ted Young, the CFO of Dorian LPG, joining us as well. Hello, Ted. And last but not least, we have Onarheim, the CEO in BWLPG, joining us also to make the trio that we're going to discuss with today. So I think I'll just kick things off and start with a very general question. We're in a market where the rates seemingly have only headed upward. So the market is apparently tight and things are looking very good. The rates now for VLGC well above $100,000 per day. And we're in what we can call high season, but what is the main contributor and what has really been driving the markets to the levels that we see today? And if we can start with, I'll open the floor for everyone, but we can start with you, Mats, if you'd like.
Yeah, no, for Navigator, maybe I should just clarify here that Navigator, we are a handy-size owner-operator, and that means that we have the slightly smaller ships than the VLGCs. It also means that they are more flexible. So we're transporting both LPG, we are transporting petchems and also ammonia, and I guess we can come back to some of these. But of course, the big driver right now is very high demand for energy and strong prices there. And particularly Europe is a strong importer of energy, and that clearly drives the shipping rates as it is. I should have maybe also mentioned that the very high rates that you're mentioning for VLGCs, that's not quite the case for handy sizes. We are starting to see more transport across the Atlantic on handy sizes also, but not at the rates that the VLGCs are getting these days.
It's been a time period for the smaller vessels having an upper hand actually on the larger vessels, so it could definitely get interesting for you as well going forward.
It's definitely moving the right direction.
And then if we jump to Anders, when will rates peak this season? It tends to be a very sticky seasonal pattern. So when will they peak and why, or why not drop off as they usually do?
Well, we certainly don't expect them to stay this level till the summer, that's for sure. At the same time, I think we are experiencing really, as Mats says, really good underlying demand, and also with the seasonality and the inefficiencies we're seeing. And of course, we're also benefiting from all the activity in some of the other sectors. So there's lots of waiting in the Panama Canal and also discharging ports. So I think that it's looking actually more sticky than perhaps is normal. And so I think we expect the seasonality will come in and we will see lower rates, but at the moment it's here just a couple of days ago we all thought maybe we've seen the top and it should start slowing down, but again all of a sudden there were plenty of cargoes out there, and so I think we're going to see, certainly we've said till the end of this year we expect high rates, but we'll face reality when the first quarter comes. So Not going to say exactly when we think rates are coming down, but it's they're looking good for a while still.
Yeah. And so if we just look at the seasonality, it tends to the trading window and the arbitrage tends to narrow a bit just due to some timing differences between US pricing and Asian pricing once you get into February, which usually takes off a bit of the demand. But I guess this year around things might be a bit different because we're in a completely, I'd say, uncharted territory in terms of energy demand and such. And so if we then flip over to you, Ted, that demand that we're seeing right now, or how is that in general? I'm talking about energy markets in general. How is that driving the demand for LPG in your view?
I mean, look, I think the biggest thing that we're seeing is obviously with the elimination or the significant reduction in Russian cargoes and Russian oil. We've seen, most notably the Middle East step into the fray. So Middle East liftings year to date are up, I don't know, 19% or something quite significant. And they haven't been that way for a while. And that's really a function of the Middle East sort of stepping into the fray, not because they couldn't produce in the past, but now they have to. So, as most of the, certainly my peers know, and as many of the investors on the call probably know, no one has ever produced a metric ton of LPG on purpose. It's a byproduct of natural gas and oil production. And so moving some of this oil production away from Russia, which in our little world of LPG is helpful because, Russia exported, I don't know, 6 million metric tons of LPG, about half on pipelines into the stands, and about another 3 million metric tons on rail cars. Sorry, and a bit out of Ust-Luga, which I think Navigator actually does quite a bit of. I give that short shrift. I apologize, but now with them producing less, the production has shifted to other areas that do produce LPG. And historically, what we've seen is, particularly in the petchem sector, in spite of the weakness, overall maybe in that sector, they tend to be the market takers. They're the price takers, and so when the economics make sense, they'll jump in. And so historically, we've always seen if you produce it, someone will buy it. And so I think there's been a bit of that going on as well in the LPG seaborne market.
Yeah. Thanks, Ted. And we discussed this a bit before jumping onto the broadcast, but I think the part of what's looking really interesting is this potential for switching effect, right? Because you have now a situation where a lot of energy and gas, especially natural gas, has headed into Europe instead of Asia, maybe. And typically the end user market for LPG has been Asia, and I guess on a relative basis that continues to stand very strong. How so to you, Mats, also with regards to what's going on in Europe, given the very elevated energy prices, what do you see of this switching effect in terms of demand? Is that something that's very supportive for LPG demand going forward?
Yeah, I think pretty much in any kind of energy is welcome in Europe. So that means both likes of ethane or LPG will be used as energy sources. And that's a good thing about LPG. It's anything, by the way, that they are quite flexible commodities. They can be used for both energy and also for building blocks for the chemical industry. So with that additional miles being added to on top of already the demand from Asia, the added new demand from Europe is of course what has taken away that additional capacity from our markets that we saw before, and means that it's really tight right now. So it really shows what big differences change in utilization can do to shipping rates. So yeah, it does make a big difference, and that switching is clearly the additional drop of oil here for us.
And also go ahead.
Yeah, I just want to add, and I think we, as we discussed also, I mean, it's hard to put a number on what sort of the additional demand really is, but there's no question we see evidence from it still. We see both of a sudden some of the new usual cargoes from some like the Equinors and others. All of a sudden we don't see those anymore in the market the same way. So there is no question there is some substitution and spiking here. And I think as Mats says too, I think underlying, I mean, we need to remind all listeners that LPG is a really good product. It's versatile, it's clean. I mean, so and again, even though Ted says yes, it's kind of a byproduct, but it's become really something that is applicable in many places. And I think many are now looking to see how can this play even a bigger role in Europe.
Yeah, agreed, Anders, because you're right. It certainly has become much more of a mainstream fuel. And, and the beauty of it is, we sometimes get the question about switching. And look, the thermodynamics and the mechanical engineering doesn't work. They're not interchangeable, which is good and bad. But obviously, but what we've seen is the soaring LNG prices have created all sorts of opportunity. One, as we've all talked about, you can spike your LNG with LPG to increase the calorific value. The Japanese and the South Koreans have been doing that for a long time. I think we had some idea that Japan could cut its LNG demand by 1.5%. This was in a quarterly piece we put out. Just by swapping in more LPG. Again, it's a tough number. Anders rightly says to get your arms around, but it can be kind of meaningful because again, our sector is relatively. We're probably in terms of metric tons transported. I think we're less than a third the size of the LNG market. Last I checked, it was like we're about 115 million metric tons a year, and they're 375 million metric tons a year. So. It doesn't take as much to move the needle for us in terms of volumes and to see tightness in freight. But Anders is 1,000% right. It's a great product. We've all as an industry talked about Evonik in Germany. All of a sudden realizing, hey, it doesn't have to produce steam for steam cracking using extensive LNG. It can use LPG. So there's as with any crisis, obviously the humanitarian one's by far the worst. But if anything good comes out of it, it's this transition and increase in another green fuels usage and potential.
And we did that math or tried at least, because you mentioned 1/3 in terms of the market, but if you then adjust that for the calorific value, then you're much less, right? So the point is when there are two things which are great with LPG, I guess. One is that it's extremely easy to handle compared to natural gas, so it's easy to place in a canister and just truck it wherever you want, so you don't need the infrastructure. So places where you don't have infrastructure, which typically is further away from the main source of gas, which would be US, right? Makes a very good ton-mile story, and as you mentioned, perhaps Mats. Secondly, the thing is that it's very high on calorific value. So you might say, it's maybe 1% or so away from natural gas imports, but I think we arrived at among China, Japan, Korea, and India as the main importers. If you switch, just assume that they'll use the spec in the gas grid to move from the lower to the higher end of the calorific value. That alone could boost demand for LPG of 5%, right? So I think it's a substantial number. It takes some time before it runs through to the actual economics and gets done, but there's definitely a lot of potential here. So, but that being said, because I mentioned a bit the thing that's easy with LPG is to truck it around, and you don't need all these infrastructure investments. Given the current energy market and the price of LNG imports, Anders, you have this India joint venture. So therefore, I'm directing this question to you. I heard some talks, the subsidies on using LPG as a fuel in India were dialed back a bit for a while. How does India look at the LPG as a solution for energy now compared to before, considering everything that's going on? I would believe that's sort of a driver for massive import need at some point.
Absolutely. No, I think you're right. The subsidies have sort of been abated a little bit, but there's still, and of course, this has been dramatically important for India. I mean, it's we're talking, hundreds and hundreds of million people now all of a sudden have access to energy, which they didn't have before. So, and we just had a stand down there now last week in conjunction with the WLPG activities there, and there's from high government officials, everybody cares. They all come, they all want to engage in discussions, and they all want to see how can we how can we even encourage you to invest more to enter this market. So India it's been a very important market for us, and we're very happy with the position we have now with Indian vessel flags and really having a good dialogue with the majors there. So India, it's with or without subsidies, it's going to be a great market going forward.
Thank you, Anders. And of course, subsidies are good when things are expensive, but if you look at the price of energy now comparing coal to LPG, you're pretty close, right? So you can make an argument that subsidies maybe aren't even needed to just push that demand even further.
No.
So if we turn to you again, Mats, on the so if we look a bit to Europe and on the petchem demand side and ammonia and such, how is that demand, which I guess is a bit more high value and probably, at least in my head, more linked maybe to the general GDP situation and with the recession scenario and everything going on? How does the demand for the petchem and such look at the moment?
Yeah, because for us, that's the two other important commodities for transportation. And ammonia has its own story. We export or we transport a lot of ammonia into Europe right now, simply because Europe has ceased most of the production of ammonia regionally, and also that all the imports from Ukraine and Russia has also come to a halt. So that means it needs to be sourced from elsewhere in the world. It's from North America, the Middle East, even South Asia, and as far away as Australia. And that has a tremendous impact on the ton-mile demand. So we used to have maybe 2-3 vessels transporting ammonia, and today it's 10-11 vessels. So it's a full 20% of our total volume. So we see that as continuing. The war, unfortunately, does not seem to end soon. We hope it will, but even after it stops, we believe that Europe will be very reluctant to be dependent on imports from Russia for a long period of time. So we see there's a very long-term story here where ammonia will be imported from competitively from maybe North America, but also Middle East. And after that, we will start to see ammonia play a bigger role as a potential energy carrier. It can be a fuel for hard-to-abate sectors. So we will see that green and blue ammonia in the mid to longer term also be an important commodity. So both short-term, mid-term, and long-term, we see the demand for ammonia transportation will remain robust. When it comes to petchems, the main change has been here that over the summer, most of our transportation went from North America into Europe, which is short mile, whereas now it's China that has started importing ethylene again. And of course, this is a much longer distance, so that means a lot to the utilization of our ethylene carriers. So very robust demand here, and we see China as being a continued important destination for ethylene out of North America.
And what about the Chinese? There's a lot of talk in several shipping segments relating to the shutdowns and whatnot, and the lockdowns relating to COVID. How does that impact the LPG or the petchem demand in that region?
Well, it seems like we have been able to, or the demand is pretty robust right now, so not so much of an impact, and we've been able to discharge ethylene on arrival without any disruptions. You could, of course, argue that if we look into a global recession coming in next year, that will impact the overall world GDP, and that also, of course, will impact ethylene demand. But of course, the seaborne liquid ethylene carried on our types of ships is only a very small proportion of the overall. So it's really the arbitrage that is the important part here. How competitive is ethylene compared to other sources for building plastics? And here it remains very competitive. It's produced very, very cheaply in North America, and we see that arbitrage being open now. And there's really a structural competitive advantage for North American ethylene production. So we'll see that arbitrage maybe be wider or less wide, but it's going to remain for a long period of time.
Jorgen, I think we expect next year. We expect there's going to be maybe another 4 or 5 million tons additional ton needed just to supply the new PDH plants. And we've seen already that we're back to pre-COVID levels, despite the sort of lockdowns and back and forth. So I think what's that? And then I think we estimate about 15-16% growth in imports to China next year.
Thanks.
So it's and this is despite some of the challenges that we're seeing. Of course, as Mats says, I mean, a severe global recession, that will probably skew those numbers a little bit, but not that much.
And it's yeah, go ahead.
I was just going to say in principle over time, I agree with Anders for sure. We're slightly concerned about the low operating rates and the low margins, and whether the PDH tonnage that's supposed to new PDH plants and/or recovery happens next year, just because they've got a bunch more coming online, and the economics right now aren't great. But I couldn't agree more with Anders that forget about the short term, over the medium term, that's going to happen.
I guess it's a situation where you're pretty much saved by the general energy demand, right? Which can compensate a lot for some perhaps more wavering petchem demand at times. But as soon as things get, as we hope, some point back to normal, then both firing on all cylinders, it seems as though demand is definitely well placed. That's at least our view on the sector, and it sounds like you all pretty much agree.
Yeah, I mean,
Yes.
look, I think from an LPG perspective, right? I mean, roughly 50%, 55%, depending on whose numbers you look at, are residential and commercial demand. That is really stable, sticky demand. It doesn't really change. Okay, if there's a big LNG project that they're doing the last mile stuff, yeah, we'll see modest declines, but that takes a long time. And then we, because of the what we've seen in energy flows, we feel like LPG is going to be a much more important part of the switchable petchem mix. And then PDH has no bid away from naphtha. So fundamentally, I think the fundamentals of what we're seeing for LPG demand are pretty compelling. There's obviously a cyclical nature to all these businesses, but there's a lot of secular tailwinds that are supporting LPG as a product.
Yeah, and I am getting some questions. And by the way, to those people listening in, feel free to add your questions in the chat, and we'll bring them up. I have a question on ammonia, which I think could be good to answer. Today's ships that transport LPG, do they need any modifications to move ammonia? And just to answer the question from the audience, there are some issues with corrosion and toxicity, etc., of ammonia, but I think it's fair to point out that ammonia has been traded in ships for a long time. It's not a new trade, and that's something that people are very familiar with. Maybe not in the sense as a shipping fuel, which is something that's more new, but in terms of ammonia being traded around, I would assume there's not too much issues with all that toxicity as such hindering flows.
No, ammonia is a difficult to handle commodity, but so is all the gases pretty much that we are transporting. They are flammable, and they need very, very high safety standards to manage. But again, that's what Dorian, what BW and we have been doing for many years now. So we have highly educated people on board our ships to handle these difficult commodities. Ammonia is toxic. You can smell it, but if you have a leak, it can be very dangerous. So that's why there needs to be very robust safety procedures in place. Yeah. It's a little bit different once you start bringing it into the engine room. When you start using ammonia as a fuel, it changes, because ammonia will not rise up into the air. It will fall to the floor, and that means that the whole setup around ventilation and so on, and how you design your engine rooms needs to be different. So it's not so easy to just retrofit one vessel from running on either LPG or LNG or something else into running it on ammonia. That being said, ammonia is a super efficient energy carrier, so it's a great way to transport hydrogen, because hydrogen is it takes up a lot of space even when it's liquid, and it needs to be kept at extreme low temperatures, whereas ammonia is much easier to handle. It's liquid at minus 33 degrees Celsius.
So that was the second part of that question. Well answered, Mats. And then since we're talking to you, we got another question because we're very familiar with how the VLGC market works, or more familiar, I'd say, than probably the smaller sectors. But do you get the same type of ARB pricing and such in your trades on the petchem and ammonia side? Is that the same driver as you do in the VLGC space for LPG?
I mean, the arbitrages are very important, particularly for petchems, and ethylene is a big commodity here. And US being a structurally very efficient, low-cost producer of most of the energy types we're talking about here, and ethane and ethylene included, this is a very important driver of the transportation demand. And here, transporting it from North America to China and to Asia adds a lot of miles, and that is great for our utilization. So yeah,
right.
It is arbitrage driven to a great extent.
Perfect. So we've nailed down that demand looks very, very good. Now let's look a bit on the supply of volumes to the market. First, I think the two main regions that we at least spend our time focusing on when it comes to exports, it's the Middle East and it's the US. And the US has really been the sort of swing additional volumes in the recent years, and is probably bound to be so going forward as well. So let's drill down a bit into that. If we start with you, Ted, the oil and gas production in the US has been a bit more subdued maybe than people would have thought, given the energy prices and everything. Give us a short answer as to what's going on.
Well, the short answer is I'd say two factors, sort of muted the production levels, but overall we haven't suffered as much. I'll get into that in a second. So what's going on? One is our oil and gas producers have been forced by most of the investment community to be far more disciplined about drilling. They want them to be focused on returning capital to shareholders. So that has been a large, they've been a lot more thoughtful about deploying rigs. The other thing is the administration in Washington has sent, at best, conflicting messages. Probably more likely more threatening messages, and so rational business people are not going to drill in an environment where windfall taxes are threatened and all sorts of other things, and sort of generally demonizing hydrocarbons. But the one bright spot has been we've seen a lot more activity in the Permian, and the Permian, fortunately for Anders and me, is has a lot of wet gas, and there's a lot of associated gas in the oil streams, and so what we're seeing is effectively more NGLs being produced in spite of the overall muted production levels because of where they're doing the drilling.
All right.
Yeah,
Thank
and
you.
I like to add to that. In all my conversations also with the oil companies, I mean, they said, we cannot make investment decisions, even though we're encouraged by the administration to, now step it up in the short term, but in the long term, again, we're going to shame you, so that doesn't work. I think they're still waiting in Houston to get a visit from the president and sit down and actually talk about this, rather than just get these messages through emails and news clippings. So it is really important. But I think, but having said that, I think, as Ted says, I mean, still we're also seeing. I think even investors are starting to see that the ESG. I mean, the E is okay, but I mean the social responsibility here of producing energy and making sure that not just Europe but many other places in the world also gets their needs filled. I think. So I sense a change from the investment community on that, and I think also we're seeing private equity players going in now and involving themselves in some of these companies, and I think that's going to also help. So we expect good growth also the coming years. But again, the political uncertainty is really what the problem is.
And how about because there's been a lot of talk about production, that's one thing, but then you need to get that gas to the vessels and through terminals and pipelines. As things stand right now, are there any bottlenecks on the horizon that could limit either through pipeline capacity or terminal capacity in terms of the amounts you can export? Go ahead, Anders.
We don't think there's any limitations there. We think there's plenty of capacity still. So to us, that's not an issue. Of course, we speak to the the players that were there, and they're always positives. I mean, you always have to be a little challenged that. But overall, it looks like the capacity is just fine. So I think we can export more than 60 million tons. No problem.
Yeah, I mean, I think I absolutely agree with that. I mean, a couple other points I'd add is one, the midstream guys in the U.S. Have a very enviable economic position. They really don't build capacity without more or less guaranteed demand, and they've got an excellent track record. If you look at any of the graphs that any of us in the sector have on the growth of export capacity, and no reason to believe that's not going to happen. I think the expectation this year is they hit sort of 86% capacity utilization on the Gulf export terminals, and next year probably goes up into the 90s. But we know there'll be additional capacity coming, as needed. There obviously are some projects either in FID or close to FID that, again, I don't see that being a bottleneck. I mean, we've just got very sophisticated midstream operators, who are going to make sure that we don't run out of fractionation capacity or export capacity.
And what about you, Mats? You have a joint venture with Enterprise, so you must be on the inside when it comes to the infrastructure side of this business.
Yeah, I guess the evidence for there being a bottleneck, I suppose, is that we have announced that we will expand our export facility, the 1 million tons that we have in Morgan's Point in Houston, because we see customer demand for much more than what is currently being pushed out, and it is the largest and almost the only export facility from that area of ethylene. So we need more capacity here, and we'll be building that, and we look forward to be better able to serve the customers in going into 2024 on this one.
Okay, thank you. And then if we turn a bit towards the Middle East, which of course is also very important, I would say, an area impacted a bit by what's going on in OPEC's production decisions. But I think you mentioned it a bit earlier on, Ted. The export growth there has just been massive. Can you take us through what's actually been going on? Is it that they're now exporting more of their domestic consumption, or is this just simply more production shining through to export numbers?
Yeah, I'd say the production levels are obviously up. I guess our sense is the Saudis in particular used to be diverting a lot to their petrochemicals plant, their SABIC facility there. We understand anecdotally there's less of that going on, maybe a reflection of the macroeconomic environment. But they've look, again, when they're producing oil and gas, as they have done, there's going to be more associated LPG. And in spite of the OPEC cuts, I think, I forget who I was reading, but I don't think it's going to be it's not going to have a major impact on LPG. I mean, it'll be down less than 1 million metric tons if that next year in terms of exports, and it should go back up again in 24. So, we all watch it, and we're concerned about it, but as Mats rightly said, Europe is not going to go rushing back into Russia's arms, and so that shift in production to other basins around the world, we don't think we think that's fundamental change. We don't think that's temporary, and I don't think we're alone in that supposition. So. And
what about the OPEC cuts that are now being discussed? Is this then?
Yeah, no, I'm saying net of that, net of those, Jorgen, net of those OPEC cuts that are being discussed.
Okay.
It just doesn't seem like it's going to have such an impact. And okay, they'll probably patrol themselves. They're pretty good about cheating or patrolling cheating, but we'll see. And again, we just don't see it. We don't see the current OPEC plus cuts that are being discussed having a meaningful impact on LPG production levels.
All right, thanks. And then if we shift a bit to another thing that ties up capacity other than just volumes increasing in distance, it's a lot of inefficiencies. And one of the things we tend to see during, I think especially during winter, and correct me if I'm wrong, we tend to have more of these inefficiencies occurring and elevating the markets during what is known as the high season, right? And What's the situation on that today, Anders? And talk a bit, if you can, about the congestion issues in Panama and the decisions that you need to make, either transiting or going around the Cape, and how that actually affects, the sailing distance for your vessels today.
Oh, it has a dramatic effect right now, and we, at the moment we're seeing, more than 20 days of waiting, and of course that's then you need to make some real decisions. And I just, of course, as the listeners may know, I mean, in the past we used to be able to pre-book slots, for LPG. We can't do that anymore. So we are subject to many other challenges, and of course right now it's LNG ships and container ships are really they can both pre-book, and they're taking a lot of the slots. And actually I just heard, was it yesterday or 2 days ago, I heard LPG slot went for $2.3 million.
Wow.
And that's expensive. And then so when you get those levels, then you really need to make decisions. And of course,
well, Anders, I just say, yes, that's really expensive, but it tells you how strong the underlying trade is when rates are $135,000 a day.
Exactly. No, I agree with that. And of course, the cost of missing your laycan is very expensive. So I think this is, and of course, this is seasonal. This is, it's not going to stay like this, throughout the whole year. But I think I think still we have to expect higher inefficiencies going forward than we see in the past, because we are, as I said again, we cannot pre-book the same way we did, and this will really have an impact over the longer term. But of course now it's extreme, and these inefficiencies that's what they will be more subdued, and that's what's going to push the rates down again. But for now it's very tight.
So they're seasonally dependent, these inefficiencies, you'd say. And what's sort of the reasoning behind that, just so we get a bit?
I mean, I think it's both because the time of year with the temperatures, and and of course you have also with trade around Christmas times. You have there's many reasons why the LNG and container ships are active. So I think that's important, of course, for us too. It's for us a period also when we have lots of activity. So right now it's we are really again thinking about if it's right to go around Cape or do the canal. We're having discussions about that every day.
And I think it's hardly going to be any fewer LNG vessels and container vessels to transit those locks anytime soon. So this is something that's just getting worse and worse, I would imagine, or better and better, depending on if you're a ship owner or or on the other end of the table.
Well, we also have now, of course, we have also now expanded, a little bit our trading side, and of course, so that's for us, it's very different when we own the cargo ourselves. So again, this is high on the agenda, internal discussions.
Yeah, maybe I hope we'll get time to touch on that as well. But then just the congestion side is, as I've said before as well, I'm a bit more familiar with all the dynamics that go into the VLGC side. But on the smaller vessels, is that something that occurs similarly, or not really much?
We don't see congestion as being an issue, and around the Panama Canal we use the old locks, so where you don't see the same congestion, so we're not affected by that to the same extent.
And I think we spoke together at another panel earlier this year in the US, and one of the things you wanted to highlight was the difference. Now let's get to the order book and the delivery schedule. So the outlook for deliveries in your sector versus quite a massive order book in the larger size vessels. How does that look?
Yeah, no, it's for the handysize, it's low, and also even smaller vessels here, it's low single digits. So there's almost no order book at this point in time. And then we're also not looking to put any new building orders into the market. We're looking to further the consolidation. We just bought 5 relatively new built ships, and that we have consolidated into our fleet, and will take over during the next 12 months or so. From Pacific Gas, and we'll continue to look for those types of opportunities, because we don't want to add to capacity in the market where we've suffered from relatively low utilization for a period of time. That has disappeared now, but let's stick to the current situation with high utilization without destroying that.
Yeah, and just to quickly summarize the delivery schedule for those listening in on the VLGC side, it's a bit of a strange delivery schedule we're looking at because it's very concentrated on 1 year. So everyone's sort of focused on what's going to come to market in 2023, but the order book beyond 2023 all of a sudden looks very, very thin. So first off, and correct me if I'm wrong, Ted, but I believe the order book to fleet is somewhere in the vicinity of maybe 14% or something for next year coming to delivery.
For next year.
Yeah, but that's 2023. How will that impact your markets?
Well, look, no one likes to have new building deliveries for sure. There are a couple of mitigants out there, and again, we're coming off. We're obviously at very attractive levels, and as Anders said, I don't think anybody expects us to stay at these elevated levels. But I guess there's some mitigants out there that would suggest more of a soft landing. First and foremost, 60 vessels are survey due next year. So vessels are out of the market for half a month to a whole month, depending on who does it and how they're operating and everything else. That's pretty significant reduction in capacity right there. And obviously we have the CII and EEXI regulations kicking in next year, which is going to require the older vessels in the fleet to slow down. I think for the younger vessels, it's probably a less than 1% speed reduction. I think for the older ones, it's 6+%. So there's some things that will create some fleet length. And as Anders rightly pointed out, I don't think any of us sees any changes in what's going on at the Panama Canal. So, well, nobody wants to have 46 vessels come into the fleet next year. On the other hand, there are some meaningful mitigants out there that suggest that may not be as ugly as it seems. And again, we've seen good volume growth. There are these inefficiencies, and again, when the ARB is wide, and right now I don't know that we see, it changes, it ebbs and flows over time. But again, this fundamental shift in energy product flows does kind of support a higher ARB, at least in the short to medium term, let's say, in our view. So, again, when there's a nice ARB, then there's a chance to make money. When there's no ARB, as we're fond of saying, you can't get blood from a stone. Product still moves, but to have a situation when an owner is willing to pay $2.3 million to get his ship through the canal tells you just how much money's on the table.
Yeah, and I'm not saying that any of you are looking to order, but let's say you were. When would the vessel be delivered, Anders? Do you have insight to that, or are you just staying all away from the yards and not even discussing?
I'm not very popular with the yards. That I can tell you. But they still give us information, and they haven't given up. So I think for now we're talking mid to late 2025. That's and of course also at the price levels we're seeing. I mean, we're seeing $93 to $95 million. Ted's been in the business much longer than I have. But I mean, I think banking on $40,000 a day plus, for the lifetime of the ship, I'm not sure I would do at least. So
no, that's the math you need to do to make the IRRs pencil. And while we've the long-term average, right, is 30,000 a day. I think the average since 2014, when the U.S. started becoming a major export force, is a little higher than that, but it's still not 40.
No, it's and just to mention, where we're coming from. You said $95 million for a new build, and you're coming from the low 70s, right? So it's been a massive increase in cost, which naturally drives up the needed rate.
Yeah, but can I just also, because this is sorry, Jorgen, but because this of course is for investors. I mean, this is the big question. In 23, all the ships, can we absorb those? And I've said before, I've been fairly, worried about it previously. I think, it is always a challenge when you get, that big of fleet growth. At the same time, given the energy markets, we just think just the export growth alone next year can absorb, almost half of that, additional demand supply. And again, that says with the continuing inefficiencies, with regulations and dry docks and so forth, we're getting closer to a balance. And yes, there might be a period, in the second quarter maybe where there's somewhat concerned, but I really think I really think we're not going to see many new builds beyond what we see now, and so we're quite constructive.
And then
Yeah.
there's the whole scrapping also. Maybe we should add that too. I mean, if you look at the handy segment where we have 120 ships, there's 20 of those have been built before 2000. So there are also quite a number, at least in our segment, a lot of old ships that will leave the fleet that will not be good ships for our large customers. So that will add some relief also.
And what again, you've been managing to sell though quite old vessels to recently, Anders, at pretty good prices, right? So there's always talk about this scrapping happening, and I know we're running a bit over time, but this is incredibly interesting, so let's give it a shot. Where do those old vessels end up? I mean, historically they haven't been scrapped, and that's despite having been through some quite poor markets also back in the day. So where do they end up, and how does that actually work out?
Well, they end up trading regionally in different trades where we don't meet them. So it's not really something that becomes those ships are not becoming competitors to us. They kind of disappear to some inter-regional trade around Indonesia or Vietnam or somewhere in the Middle East. So
yeah, we
don't see them.
Yeah, we certainly care about who we sell to, and as I said, we sold 19 ships the last several years, and you know, so we're not going to sell to. We don't want to meet those ships, you know, right away, you know, next week. So we're quite careful on that. But I think again, and I'm always happy that you mentioned this, Jorgen, because of course I think, you know, we always like to at least say that we're becoming more of a liquid sector, but the ship values and underlying values are perhaps more correctly reflected also, you know, in action. So I think it shows that our market is becoming more liquid, and I think we're all happy to see that.
Yeah. All right. And then let's talk a bit about valuation here to end the call. Given where the stocks have been trading, you know, you're reaching pretty much all-time highs in terms of share prices and such, and reflective of quite elevated values, but you're still at a massive discount to where the quoted values are these days for vessels. Why aren't people buying into the story and fully pricing up the stock, Anders?
Well, I mean, you're the analyst. You probably had those good discussions also. I think, and I'm just going to repeat, you know, that we're not going to push our own share prices. That's not what we're doing. But I think what I think we need to just continuously, I think, tell people, both LPG is a great product. It really is, and it needs to be transported. And I think, you know, LPG ships in general are, you know, quite adaptable. As I said, there's many things we can do. I think, of course, we like the bigger ships. We think they're simpler. The routes are you know, more predictable and so forth. But I still think that this whole segment, we have so many opportunities, whether it's ammonia, whether it's LPG as fuel, because of the smaller ships can be, you know, ship to ship. There's many things we can do. So I think it's just we need to educate and make sure that people understand that even though we're byproduct, we're still the real deal. You know, if there's going to be LNG, if there's going to be oil, there's going to be LPG.
And that's why we have this webinar, I guess. I hope all the investors feel enlightened and want to jump on board the journey from here. Just finally, Ted, you know, I think what investors like over time is definitely getting their money back and cash paid out, right? And then we get to Dorian. They have an irregular but quite regular dividend going on. What's sort of the value of having a transparent dividend policy and trying to build some confidence for investors that they'll see their money back, do you think, Ted?
Well, not quite sure how I interpret that. You know, I think from our perspective, we've been quite clear that when the cash is there, we're going to return it. I think if we see market conditions turning, we're not going to, we're going to build cash, you know, either defensively or to take advantage of opportunities. And you know, so far, well, I think you've probably been the most vocal of the analysts, arguing for a mathematical policy, I'll call it. You know, we don't feel that that's something that will ever be fully priced in, because if we had 100% time charter, we think we get a lot more credit for the dividend than we do otherwise. But I think on the other hand, we have now started to develop a track record among investors that, hey, there's cash, they're returning cash, they're going to continue to return cash, and they do put shareholders at the forefront. And so if I think probably Anders said it, in the context of vessel prices, but I think actions speak louder than written words of like a dividend policy. And so the fact that we've been doing it, I think matters. Others, and I don't dispute anybody who does likes to go with a more linear policy. We get it. It just doesn't really. It's not as comfortable for us in terms of the way we look at our business. And so we think this is the best way to go to look out for shareholders' short and long-term interests.
True, and it's, I guess, being exposed to a spot market that's all over the place through a year. It's also quite difficult to get that confidence going, despite the mathematical formula, maybe in terms of what that return will be and dividends will be going forward.
But yeah, at the same time, I think it's important also still for us to understand that yes, it is volatile. At the same time, I think both Ted and I and also Mats will agree. We think we earn much better returns by not just locking in, all in the TC long term. I think we've now shown over time that we can, generate excess returns by understanding the volatility and positioning ourselves and working hard to even in the tougher times to still be cash positive. So I think I think over time, I think investors will see that we do manage to handle those cycles quite well.
All right, I see we're now approaching the hour almost, and I guess we could chat for hours, but I wanted to touch on this finally with you, Anders, the trading part of the business that you've now included and sized up or scaled up is probably the right way to put it. What's the value of that for being a ship owner in this sector?
I think, as you know, we started out dipping our toes and just started very carefully and to see how we work and to support our shipping and help our utilization. I think what we've seen is that this has given us great optionality, and we get a much better information about product flows. We see we can enter into different type of contracts that are quite beneficial. So to me, I think the key word for me is the optionality it gives us, and so that's something that we are very excited about. And of course, now we just now finally got the green light to include the team full time with us, and so far we see it gives us great additional. It's both an additional revenue base, but as I said again, also just the analysis and information and product flows very important.
All right, thank you for that, Anders. I see Nicholas is back, so we'll need to cut it off here. And I just wanted to, in the end, thank everyone. And I see I have quite a few questions that have come in on the Q&A, but unfortunately not time to get through all of them. But with that, thank you to all the panelists and all the listeners in, and you also, Nicholas, for organizing.
Well, closing remarks from me, just to say huge thanks to you, Jorgen, to Anders, Mads, and Ted. Great panel. So thank you very, very much.
Thank you so much for
Thank you.
Thank you.
having us.